Hi everyone, I'll let you all get settled in. This is going to be a fast and furious on how to value your startup while you're having a lunch. I hope I'm not going to give you indigestion, or and I also want you to have some space to actually write some notes, because usually I go through this kind of content in probably about an hour and a half. I mean, I could take 3 hours really if I'm going to go through everything, but so this is going to be like a real, as quick as I can deliver as much value as possible in about the next probably half an hour, and then I'm going to be opening up a Q&A, and we're going to be keeping an eye on that, and we'll probably deal with most of the questions at the end, because it's going to really kind of break things up if in a not a good way if we're actually get questions in the middle. So I'll leave the questions to the end, but I'm going to let you get a bit settled in. I'm going to get going, and I'll ease in very gradually. So first of all, why is valuation important? If you don't get it right, then it can make raising capital like really difficult, and not just difficult, but cause a lot of problems further along the journey if you sell it too cheap. But if you can have it too expensive, so I'm using the Goldilocks analogy here, if you didn't already guess. So you have all apologies when you offer it out too expensive, it's too hot for investors, basically. Maybe it's too cheap, and that's a little bit off-putting, a bit too cold. What you're really looking to do, and this is what I'm helping you to try and get on this brief webinar, is to get it just right, or as best as you can, kind of like in the Goldilocks zone, going into more kind of astrology. Yeah, so basically too hot, overpriced, really, it gets really hard to get invested in then, and too cold, underpriced, potential loss of control as well. So we're not only, it's sometimes a little bit off-putting, because it's like if you sell a house that's been on the market and it's really cheap, people are going to think there's something like really wrong with the foundations, or goodness knows what termites you've got there in the loft, and so on. So yeah, we want to get you in, at least in the zone. It's never like 100% accurate, it never will be, but if we can at least get in that spot, then it will certainly give you probably a lot more confidence when it comes out to talking about valuation for your own business. And I know a lot of you actually, I've over the many years that I've been doing this, this topic comes up over and over and over again, and the most sophisticated and the most experienced entrepreneurs sometimes feel very not confident at all when it comes to telling the investor as to what the valuation is for their business, and that comes across. So, and also the dreaded kind of comeback is to, well, how did you come up with that valuation? That's what the question they don't want to get. So this is what I'm trying to do here on this. First of all, I'm going to deal with the traditional ways of valuing a business, which can work sometimes for traditional businesses, but this is like slow growth, steady businesses that have been going for probably well over 5 years, maybe even 10, 15, 20 years, but they don't work with startups at all, because it's a different kind of, it's a different type of business. So we got net asset value. I'll skim through this really quick, so it can be a little bit dull for many people. So net asset value is basically, it's like your balance sheet. I mean, your accountant will be able to do this one quite easily. It's basically everything that you have as a value. Could be some property, could be a car, could be cash in the bank, could be money that customers owe you. So there's all of the assets that you would have. Typically, the IP is more often not included, or as a token it's included. They might throw in things like goodwill, which is like the loyalty of your customers and how many you expect to come back. So you take all that, and you basically deduct all of the things that you owe, including creditors, any tax, any payroll, staff, and then once you've taken that off the net asset, then you're left, well, on the assets, you're left with what is the true net asset value. This is the worst way to value a company. Even an actual company that's been going some time, You really do not want to be doing this. If this is the valuation that's happening with your company, and it's usually that the liquidators have got hold of it, so which is not a great way to value a company. So let's forget that one, but at least you know it's there. Then a multiple of revenue. So this is one that you might commonly have heard of, that you'll hear of a company that might have sold a business, and you've heard that they get like 1 times revenue. So if they were doing it's 1 million turnover, then the company sells for 1 million. Sometimes it could be much more. It could be 2, 3, 4, depending on the industry. But obviously, as a startup, as a fast-growing startup, you really don't want to be valued on the revenue, because it's going to be small. In a lot of cases, it's going to be really small, and in many cases, not non-existent. So let's kind of park that one as well. So we've got the multiple of net profit, EBITDA often called. I'm not going to go into break that down because I haven't got the time, but it's ultimately the true net profit, taking all the other kind of accounting terms out of it. And now, same sort of thing. The actual multiple is an industry standard that's taken for different sectors. Now, a very common conservative one might be 5 times EBITDA or net profit. So if your net profit is 1 million, then obviously the company's worth 5 million according to that particular multiple. Now, again, as an early stage business, this is not something you want to be judged by, because they're probably not making a profit at all. In fact, it's kind of unlikely you make a profit for probably at least 3 years, maybe 4, and even then it's going to be small, because you're going for high growth and you're usually going for the exit. Cash flow discounting. Now we get into a real accounting land, where what you're doing is you're trying to predict future cash flows and then discounting it for risk. So you are kind of peeking into the future. You're looking into the past, seeing what is really predictable, how the company has just onboarded cash or profits through the company, managed to retain them. Then you measure it for risk. So it might be discounted by as much as 20%, 30%, maybe a bit more. And then you're trying to figure out that they're buying the future revenue at a discount. So again, it does actually, this one's a little bit more viable. It does actually suit one of the methods I'm going to go on to that does work. But if you're going to use it in its pure form from an accountancy view, it's probably not going to work for you. So talking of accounts, and maybe there's some accounts here or not, I don't know, but accounts are great and they can really help grow your business and be a massive support. But I found that there aren't that many accountants that can do the valuation for a growth company, that is like a really early stage company, because ultimately, accountants are generally great at measuring the past and present. That's what they are there to do, to accurately do that, so you can make some decisions going forward. But when it's not so great at measuring the future, this takes much more kind of thinking through different options. Many accountants are not happy to just flying in different directions, just like literally time traveling, seeing what might happen and what might not happen. I do actually have come across some that can do it, but it's not very often. So it's not sort of thing you just say, hey, don't worry, I've got that covered, I'll give it to my accountant, because you're going to end up with a very low valuation, basically, because they're trained to be conservative. So ultimately, we are still trying to get you in that Goldilocks zone, and you're probably not going to get there. But here's the secret. There is actually no definitive scientific way to value a startup. Often everyone pretends to know what they're doing. And you might think the higher up the chain and the more experienced, that they've got it nailed, especially on valuation. I think they must know exactly what the valuation is. But for early stage companies, everyone's playing a little bit of a guessing game. But there is kind of calculated guessing. And so it's just to kind of bear in mind, because this is like, well, I'm not going to be able to deliver it. It's like an exact formula that's going to work every time, and everyone's going to nod their head and think, well, they nailed that one. But again, we're going to try and get as close as you can, get you in the ballpark. Before we get into the actual valuation methods themselves, I think I should deal with pre and post money valuations, because sometimes there's a lot of confusion around this, because no matter what, from going forward, I talk about valuations. It's quite easy to get lost on these two terms. And if you don't actually understand them, and when you're talking to investors, you kind of, for example, you might quote a pre-money valuation when the investor often might think that it's automatically going to be a post-money valuation. So let's just clear this one up, shall we? So pre-money valuation. See here, you've got an empty till. Like, just look at the till as if this is your particular business. It's kind of like a machine. Okay, it's not like a fully formed machine, perhaps, but it's got it's got product, it's got some system behind there, maybe got some early interest of customers, but there's probably not a lot of cash in the bank. I mean, that's why you're going looking for capital in the first place. So it's pretty much an empty till. It's before that investment has gone in. So and then post money is when the investment's gone in the till. So now you've got your original business and all the kind of advantages that business might have, all the potential of its future growth is still there. That hasn't changed, but the only thing that has changed is that original investment has now gone into the business. So let's just use a very quick example. So let's just say that you're going to value your pre-money valuation at £1 million, £1 million, because maybe you've done. You've got the product, it's ready to go, you've got some early customers, maybe you got a little bit of IP, the team looks quite strong. So you're saying, I think this is okay, we're early, but this is worth this. Then the investor said, but we're looking for £100,000. The investor will then say, okay, well, hopefully we'll say, sounds great to me, I'll put the 100,000 in. Now it's worth 1.1 million because obviously the £100,000 gone in. So when you tell the investor, there's two ways you can tell them. Say, well, it's a pre-money valuation of 1 million, or it's a post-money valuation of 1.1 million, assuming that their 100K would go in there. Obviously, that does make the difference when it comes to actually calculating the equity stake that they would have in the business. So an easy way of doing that, I'll do it an easy way, which is, let's say the pre-money valuation would be 900,000, but you'll say to them, well, we'll give you, if we can have £100,000 for an investment, we'll give you a 10% equity stake. That would be the same as saying it's a post-money valuation. So because once the 100,000's gone in, now the company is worth 1 million. And because they put 100,000 in, they get 10% of the company. So I hope we clear that one up. Do ask me any questions, and then I can maybe clear that up if there's still a bit of confusion around this area. But we're going to get going. So I'm just going through, I mean, there are many ways, and some ways, some investors even got their own weird hybrid versions of doing valuations. Some investors will never even tell you what their their actual approach is. I've had some investors that, I've known, and I asked them just out of curiosity, oh, how do you value? I say, oh, I don't tell anyone that. Keep under the chest. So, but these are here are the common ways to value the startup that generally I would say cover at least 80% of most situations. So now, by the way, these methods that I'm talk about, if you look up the apple and pears method on Google, you probably will not find it. I doubt it. And also the poker hand method and the time travel method. So these are methods that I'm just trying to wrap around and like a common way that it's done to make it easier to understand. And I like renaming things anyway. So let's just start with the apple and pears method. So this is like, imagine that you're basically walking into a marketplace and you're going to see obviously apples and pears and loads of other fruits and goodness knows what. But if you see an apple priced at £1 a kilo, walk a little like 2 stalls down, you see one for like £1.20 a kilo, and then a few stalls down from that, then it's £1 again. The £1.21 is something going to look a little bit expensive. So it's literally trying to compare something that is at the same stage in the same sector, and then just giving a kind of an estimate of how yours compares to others in that sector at the stage. So here's how it works. Basically, identify your business sector as the number one. I would spend a little bit of time on this because this is kind of key. I wouldn't just say tech business, because that's just a little bit too generic. You want ideally, if it's going to be clean tech, maybe, or med tech, perhaps, or maybe it's not tech at all. Maybe it's an actual product. Maybe it's a beer, or maybe it's a kind of condiment, or maybe it's an actual B2B service. But either way, I would, you probably know already, but identify your business sector, and then decide which state of development you are. I think this you're probably going to know already as well. So are you pre-product, post-product, pre-sales, post-sales? They're all quite self-explanatory. But taking those two things alone, I would then try and research maybe, it doesn't have to be 10 companies, but I'm just being on the safe side here, but you can have maybe 3, 4, 5 companies at least that are not complete outliers. So they're not like, we've got like a superstar entrepreneur running it that's had 2 successful businesses in the past, or it's already attracted some VC capital, or some other kind of real outlier, because these obviously events do happen. And then if you'll start measuring yourself up against that, then you might be in trouble, and you'll definitely be knocked right outside of that Goldilocks zone. But you want a good broad amount of companies that represent the same profile. Ideally over the past 2 years, maybe they've gone raise capital over the past 2 years, but you know, if it's 3 years, 4 years, it's probably not a big deal. And what you're trying to do is get to the mean valuation is like the average of these 10. So, you know, you add, like if you've got 10 companies and the average valuation is $1 million, well, I'd say like it ranges between, you know, 800,000, 1.2 million, 1 million, then you add them all up, divide by 10. Yeah, that's what I mean by the mean. And then you've got like you've got some kind of measuring stick at least. You're not completely going out cold. It's not the best technique, I don't think, for valuing a company, but it's kind of workable. And sometimes it's a good like backup when you're trying to justify the other forms of valuation. So yeah, but a lot of the actual work is actually in the researching. So I would spend a fair bit of time on that. And some ways you can find out quite easily actually is you look at past crowdfunding campaigns like Seeders and Crowdcube. You can go on to Crunchbase. There's many other databases, or even just search for companies that have raised capital, get an idea of the sense of their valuation. Of where they are. So that there's a lot more data out there than they ever used to be. So it should be relatively easy. And then there's also the IPM Business Center at the British Library that have a whole databases offering kind of tools for this kind of thing. So that's that one. That's the apple and pears method. So an example, just very quickly on this, I got the craft beer company. For example, it's early stage, it's post-sales, under 100K revenue. This is kind of like a typical kind of beer company that's been going a couple of years, maybe even 3 years, because it is a bit of a slow burn on this kind of product. And then they're identifying 10 craft beer companies, like I said, on these different sites. Add all the valuation together, divide by 10, and that's it. And then they're kind of good to go. This is kind of a really kind of quick way of doing it. So yeah, but also if you're gonna doing your research on Crowdcube and Seeders, do bear in mind that often the valuations on there are, I would say, probably usually about 20-30% higher than usual if you're going to go for a professional angel round. So I would consider discounting by 20 or 30% about like below the actual mean that you find. Okay, so that's that one. We're going to move on to the poker hand method. And here you basically imagine that you've got, like, I don't know how many of you play poker here. Hands up who actually plays poker here, just out of interest. you don't have to know how to play poker to get this method, obviously, but it's kind of a useful analogy because I don't think there's many other kind of games that really do like simulate the actual like how raising capital process, because ultimately when you're in the early days, what you look to do is get the best hand you can. Now, it's not going to be a perfect hand. It's not going to be a royal flush or anything like that. It's just going to be probably a good like, I mean, the cards you can see there, King Ace is the best start you can get. But even then, there's no guarantee that you're actually going to win the game. But the odds are in your favor. So an investor would actually bet on that hand as it stands, and because some of the risk has already been taken out. So this is what we're trying to do. We're just always trying to reduce risk to the investors. So what I've done is I've broken it down into basically 5 cards. So imagine that he's an investor, you've got the 5 cards in poker laid on the table. It's not all done yet, so you could still lose and you could win, but if you've got a really good hand, the odds are that you're going to win. So the cards are, and you assign a value to each one, is the idea. So the idea, is it like a fairly unique idea? Is it a big idea? And is it an idea that's sustainable in the marketplace? Is it big enough to make money as well? And is it an idea that can easily be defined? And does it hit a really strong pain point? So what you do is you really do examine your idea and think, well, how strong actually is my idea? Is it fairly unique? Is it big enough? Is it defendable? Maximum value of 250,000. Now, this just to say that this method is taken partially from there's 2 very experienced angel investors in Silicon Valley. One's called Dave Burkus, and I think one called W. Payne, and they both have a kind of fairly similar method to this, but I've taken out, I've really adapted it for the UK market because some of the dollar valuations don't really fit this market. So just bear in mind, this comes from that. I haven't just plucked this one out. But each, like for example, the idea will have the maximum value of 250,000, the team 250, and as you can get, it all goes down 250 each for each. So the team would be really strong if you had like maybe it's yourself, maybe you've got a co-founder, but it doesn't have to be a co-founder. But you've got like maybe a couple of strong executive members. Maybe you've got some board advisors, 3 or 4 in specialist areas. It doesn't mean you have to pay them. It can mean you're just paying them options. Or you've got a non-exec director as well, or maybe 1 or 2 of them. But basically that team looks set to scale. It looks like a team that can really take that ball and run with it. And when they get investment, you kind of know they can probably execute that great idea well. And maybe not up to 100 million pound level, but you can get it to 10 million on that team. Market. So when you want a rising market ideal, a market that has a double-digit growth predicted at least over a next 3-year period, and the market's got to be highly defined. It's got to be easy to reach. So you basically want to play a game to win. A lot of entrepreneurs enter markets that's just nigh on impossible. It's a declining market, static market, very expensive market to get in. It's difficult to reach customers. Could be all different reasons, but you're trying to like at least get an assessment of how strong that market is. IP and protection doesn't have to be patents, but it's like ideally some protection around, can that idea, have you got some kind of leg room in there before the other competitors start jumping in? Have you clearly identified your space that you're going to operate in? So, all the other players in the market have got their own space and they serve the customers well, but you spotted a gap in the marketplace. Now hopefully you can find a way of protecting that, whether you get exclusive contracts with suppliers or clients, or you control the supply chain completely, or it takes too long to catch up. Whatever it is, how strong is that? And then the traction. Okay, what have you done to reduce the risk to the investor so far? And how far can you? How far have you taken now? Maybe you've got some subscribers, maybe you've got trials going on with companies, maybe you've got JVs, joint ventures with other companies that reduce the risk. It could be all kinds of things there that you've done to reduce the risk alongside the basic idea. So, and then you just take your current value, what you think of the cards, and then you add the value up. I think I've got an example here. So let's just say, okay, so I'm just going to go with a beer company for now, because that's I used that before. But say you got the idea, they've got a maximum value on this one. So the idea's got to be pretty darn knockout. So let's just say, let's go to a beer company. What would that look like? Well, to be honest, it'd be quite difficult to get to a maximum with a beer company, but it's just give the ideal would be to where they've got a specific brand that is built around like maybe a kind of a growing kind of idea or concern. It could be something like it's a first gluten-free beer. I know it's not a first at the moment, but it could be something around that, socially responsible beer. It could be local. It's like highly local, built around a particular kind of ethos. But the idea has got to be like laser focused, not just yet another beer company. Or it could be even the way they do the beer, or they specialize in a certain type of beer. But that has to be a really strong offering, so that the entrepreneurs will be easily able to explain what the beer is about, and the investors will instantly get it. The team, that would mean they have two that if it was 200 out of 250, that would mean that the founders might be pretty strong. Like one would have a good beer background, maybe a brewer in the past, maybe you've got a marketing person who's like either a co-founder or just another member of the team. It could mean you've got a couple of board advisors, but you haven't yet got a really good non-exec that can open doors, can maybe help leverage things for much larger expansion. Maybe it's not quite there on the team, but that's pretty strong. Market, maybe on the market, yeah, they've hit the trend just right, and that trend indicates that there is a double-digit growth over the next 3 years, and also there's plenty of scope in that market to make money for the next 5 years, maybe even 10 years, and enough in that market to be able to make the company at least grow to 10 million within a 5-year period. Then you've got IP and protection. This one, no, they can't really protect. They can protect the formula. Actually, this probably could have some protection, to be honest, where they could protect the formula behind each of the beers. But let's just assume that they can't do that. Someone could easily just work it out. So they'd lose those points. To be honest, the IP and protection is one of the hardest ones to get beefed up for the maximum 250. And then the traction, just to say, like, they have got some early sales, got some good supporters. So go back again. They got a database of a couple of thousand, perhaps. The beers, is in cans and bottles. They got a supermarket maybe interested. So you've got a significant amount of interest, but it's not fantastic. It's good enough. So yeah, maximum value 850. It's an early stage company. So, it's not barely any sales going on at the moment. Pretty much it's often classified as pre-sales. And that's an example. So that's the poker hand method. That I would say that the poker hand method is mainly used for pre-revenue businesses, because it's going to be, as you might have guessed, it's going to be relatively low against what you might be reading in the press and TechCrunch and everywhere else like that. But there are outliers that would go beyond that. But the one that I generally favor is one called the time travel method. Well, I call it the time travel method. So basically, we're selling the future of what you're doing. And if you've got an exciting business, it can really capture a market. It can capture the imagination of the investor. You're selling that. This is how a lot of the big entrepreneurs do it, and they raise a lot of money with VCs and so on. But you don't really even have to get to that level. But you do need to focus on the actual value that you're selling going forward into the future. So you're going to get them to step into that DeLorean and then set the clock for 5 years. zip to 5 years and then take them on a tour as to what would it be looking like. How many customers would you have? How many product lines would you have? And more importantly, what is the potential exit that you're going to get them, so you can give them a really good return on their investment. And by the way, they're on average for an angel investor anyway, they're looking for a 10x, 10 times their money back. So that's what you're trying to show them, that in 5 years time that you will be able to create a business that's going to be able to deliver them a 10 times return on their investment. So to sell the exit, we're basically looking at 5-year timelines, as I mentioned. We're looking at, the strong look at the exit, like what is possible here. So trade sale is the most likely, but then private equity is also on the cards again. But private equity only really comes into it if you have what they call a 10-2 company. It's a £10 million turnover and £2 million profit. That's like a sweet spot for private equity. They like to snap these sort of deals up in that range, and then they know they can probably 10x that particular deal over the next 5 years by basically scaling what you've got, either nationally, internationally, and so on. So you just need to demonstrate that whatever you've got is a good opportunity there for someone that's going to buy it. Identify who would actually be buying the company, why would they be buying it, maybe find case studies of companies that have been sold in your sector in the past. Is the method. Research at least 3 historical exits. I mean, ideally, more is the better, really. But this is what we're trying to do. So you're trying to find companies in your sector that have actually sold to, it could be private equity, could be another trade sale. Usually it is, they do actually, well, not always, but they can actually often say what it was bought for. You can look at company's house and work out what their profit or turnover was at the time, and then do your own calculations. Sometimes they even say outright what it was sold for. Crunchbase are quite good at coming at information like this, and other databases similar to that. So basically, you're trying to work out what the historical exits are. Then you're trying to find, going back to the multiples again, this is like, for example, a company might have sold for 10 million and it had a, say, 5 million turnover. Then you know that the multiple was like a 2 times turnover as the multiple, is how they sold. Or it could be they're making good profits. Maybe they weren't making profits, so it's done on turnover. Maybe they were making good profits and they were making £2 million profit. And again, it was and maybe sold for 10 million. So it's again 5 times the actual net profit is the multiple. More often than not, you're going to find multiples probably much higher than 5. More in the region of probably sometimes 2 times turnover. Sometimes it could be in the region of 10 times net profit. But what you're trying to do is, it's different for every market and every sector. Some sectors are just terrible for multiples of exit, and others are just mind-blowing. Fintech, for example, mind-blowing multiples of the exits. So what you're trying to do is calculate, obviously, take this 3, exclude any outliers again, any kind of really crazy deals that just like really took off like a rocket. Stick with the ones that are just a little bit more sensible, and then calculate the mean. So basically, add up the actual multiples in each one, divide by 3, and then you end up with the mean average. But again, we're going to go discount now, a bit like that earlier version, the method that I talked about, the cash flow discounting. What you're trying to do is you're trying to then slice off the risk. Obviously, you haven't got there yet, and there's a hell of a lot of barriers and parts of the journey that you've yet to get through. So obviously, there is a significant amount of risk. So depending on how much you've done today, I would even start at 50%. Say, look, we've averaged these multiples, comes up at the average multiple is 10 times EBITDA, but what we're going to do is we'll discount it by 50% because, for risk. Now you take your 5-year EBITDA and your forecast and your financial model, and then multiply it by that mean discount that we come from the examples. And then finally, that basically gives you a potential exit, your potential exit that you're telling investors you're kind of aiming for. But now we want to get back into that dilemma and travel back to the present day. So to do that, we just divide by 10, because remember, we're trying to give them at least a 10x return on investment. And so, that will give you a relatively sensible current day valuation, at least again, ballpark, Goldilocks zone and all that. So then you should feel pretty confident that you're at least on pretty safe ground. You got some room to negotiate. Just going on to pricing a little bit more, just basically what you're doing, and particularly with this method, is always thinking about the end game. So you're thinking not just about this round, but most likely you're going to probably, if it's a fast growing company, there's a very good chance that you're going to be doing probably 3 rounds, sometimes even more. I've had some clients that have done 4 rounds and they're still not done yet. It depends how big the rounds are, of course, but you need to strategically think about, even at this stage when you really don't know kind of like what you'll be doing next week, just try and really think like a chess grandmaster and just try and think, okay, so if I sold the valuation on this round at this price, what would the next round be? What would the round be after that? And what would be my equity stake? How would it dilute over time? Would I still have a majority stake after all the rounds are said and done? Because ultimately, as entrepreneurs, there's 2 basically mindsets. Is either the mindset of, I'd rather have a small slice of a big pie than, like a big part of a smaller pie. There's that, but then there's the case that why did you go into business in the first place? And many entrepreneurs that I've come across, and I've obviously been through this myself, is they want to be captain of their own ship. You don't really want to be, the quartermaster or anyone else as part of the crew. Usually, you want to be running the ship, and it doesn't mean you're making all the decisions, but it means that most entrepreneurs want to have some degree of control, and if they want to decide to go in a direction and they get sensible feedback, they want to be able to do that and not be stopped. Also, they don't want the salary capped and various other things. So I would suggest you just think about that at least. I've got time to dig into this. I usually dig into this a bit more, but and then the valuation for entrepreneur, like I've basically given you like a rough idea of how to actually approach angel investors, but this does not like strictly apply for a venture capital. This is like, I could go on another 15 minutes on this one, but I'm just really just highlighting that the game does change when you get into VCs. The whole of the game is much more geared towards the exit, and nearly all the negotiations around what happens at the exit. Valuations are often linked to what is in the shareholders agreement that you've got with the VCs. There are loads of different terms that you need to be aware of. At this stage, I would just say, just get a very good investment lawyer, and also be prepared to maybe up the valuation a bit to counter some of the loss of control that you're going to get. But yeah, anyway, whole different game, but I thought I'd just highlight that. So basically, in a nutshell, how do you actually justify a valuation? You've got the investor on the other side of the table or on the other side of a Zoom call, and they say, well, how did you come up with that valuation? So you're saying, well, ideally, if you've got any professional investment already, you can use that to sell the justification. At the moment, you can go through like all of the 3 methods that I've gone through. You can, measure each one against the other, come up with almost something you're happy in the middle, or you could go for the future method. But let's just say that you managed to sell that to an investor first of all, and they're happy with it. Now that makes things way easier, because now you've got like a kind of validation from a professional investor, especially if they understand that sector. So, that makes things so much easier. You just then you will say, well, we've already got some investment specialists, or he's a professional in this particular sector, and they seem quite happy with the evaluation that we came up with, but ultimately we're looking to give a 10x opportunity. Now, again, going back to the VCs, a 10x opportunity is not good enough with VCs. Like, they're looking for 100x opportunities, so you've really got to up your game with those guys. But you ultimately, if you're turning professional investors, angel investors, yeah, we're looking to deliver a 10x opportunity. You know, we've done a business model that really does demonstrate that. It's about as robust as we can get. We've got so many different variables and assumptions we've validated. So ultimately, yeah, we're looking to give investors 10x opportunity. And so far, we've actually reduced these risks. We've we've got a great team. We've onboarded these people. They've been in the industry for many years. You'll also say we've tested it in the marketplace, and so far we've built up a waiting list of 2,000 people that are ready to get their hands on this product. We've tested the product as well. We've done loads of iterations and focus groups, and we're very happy with what we got. We've got JVs with these 3 companies, and so on. So you bullet point the risk that the validation, the market fit, and things like that. It all adds up in value, just like the poker hand method. And then you say and also we've looked at this particular sector and what other players, what other kind of companies have got in terms of valuation, and we come across these 3 that been at our stage, in fact we were probably a little bit more ahead of them. And they're asking this, but we're not going to ask that. We've discounted it a little bit more for you because we want to make sure you get that 10x opportunity. And also, we're in a marketplace that is due to grow by 10% over the next 2 years, 3 years. So we're on a kind of rising tide, and we're looking to take advantage of that. So hopefully we're in a good space right now. And if you were to give something like that, then you'll be head and shoulders above any, I would say the vast majority of entrepreneurs that when asked that question, then you give that kind of response. Most investors will be pretty blown away because you're starting to think like them. And that's what they want. They want in terms of a return on investment, 10x return and so on. So how do you know if your valuation is too high? You might be a little bit skeptical about how do you know? Well, your market will tell you, just like you've got a house on the market, that house will remain unsold for a long time. So if you're really struggling to raise capital for your deal and you can't really figure out why, the thing is, investors do not tell you more often not that you're too expensive. Some do, some don't. But if you were putting out pitch decks and 1-pagers and you're not getting investor meetings and you've got that valuation on there, it could be that it's just a little bit too high. I asked one small VC, I said, what's your biggest bugbear? And he says, oh, meeting entrepreneurs when I don't know their valuation, because then I know I'm probably wasting my time. I've got a conversation with them for an hour, and then I find out they're too expensive. So, I would be very wary if you're not getting much back. So just to wrap up, next moves, do your research on maybe other companies, for example, that are in your space, the valuations they're getting. I also recommend how to read a cap table. By that, I mean, thinking like a grand chess master, as I went into, is what happens at each stage when you sell shares. So the cap table is what investors own what shares, but that includes yourself. So at each round, how does your shareholding look if you go through, say, next 3 rounds? The first round might be 150, the next round might be 500,000, and the round after that might be 2 million. How's it going to look roughly? And you can just play around with the numbers. You can get all kinds of templates online about cap tables. Also to figure out your exit strategy. It's probably not going to take that long, but it's just a massive value add if you can figure it out and you can easily articulate it to investors. And do decide on a high or low valuation for negotiation, because like I said, this is the Goldilocks zone, but ideally, if you price it right, you want to price it slightly on the edge of high on the Goldilocks zone. And you have to figure out what is the lowest that you could accept, because it's easy to get caught up in the emotion of the evaluation and negotiations, especially if you're really kind of feeling a little bit desperate for it. And then you can easily end up with a really kind of like a lot of remorse around actually the deal that you've done, and you're going to have to live with it now for the next 5 years. So do really think, again, strategic before you go into investor meetings and discussions. Think about the high and low. Wow, this has taken a long time. So thanks for staying with me on this journey. I didn't intend it to be quite so long, but I did the best I could. I'm quite happy to respond to any questions now.
Hi, Paul. Thank you so much for that. That was incredible. We've had quite a few questions come in. So you guys are welcome to raise your hand now and come up to the stage directly to ask Paul a question. But we'll answer some questions in the meantime. We've had quite a few come in. So I've got this question from Indy. She says, how does valuation work for businesses closed due to COVID, lockdown, and currently no sales? With the business valuation as a startup business, or can figures from previous sales be used in the valuation? Is there such thing as an old startup?
That's a really good question, and obviously it's quite common at the moment. So it depends. What it depends largely on is your customer base. So if you've got like a good customer base, or we used to have one, and let's just say you've had 1,000 customers previously that were on, ordering regularly, or you had B2B clients that were ordering regularly before you had to close down, then there is value in that. So you could, and I have had actually companies been through this, by the way. So so that's got value. Also, remember, talking about the future is the ultimate value. So you could say, okay, we closed down due to COVID. We were doing all of this beforehand, but now we've had a chance to really think, and we're going to restructure what we're doing. We're going to pivot. We're going to go in a different direction. We think there's a bigger opportunity now than there even was before. And you start selling the future vision. So what it means is ultimately is that it depends how big your vision is, really, and how well you can sell that, and how well you can basically incorporate or validate it through your business model. And because you've been in business before, you could probably validate a lot of the figures, conversion rates and all kinds of things. So, or, average order sizes and things like that. So ultimately what it means is that your future vision, whatever it is, it's not going to be quite so heavily discounted as it was if you were going completely cold. So normally the discount on the future might be 50%, for example. So, but because you've been in business before and you know the game, it might be, maybe 25, 30% discount. It won't be so heavy.
Perfect, thank you. We'll just take one more question from the audience before we have 3 people wanting to come up to stage. So Ryan says, when building pre-seed and growing revenue streams, one and narrow build multiple simultaneously. I'm not sure if that makes sense, but does he build pre-seed and growing revenue streams?
Which was that? Ryan.
Maybe we'll go on to another question, so I'm not 100% sure what that means. Ryan, would you mind clarifying what that means? Does pre-money valuation include the founder's investment?
Good question. No, it doesn't. Unfortunately, no. Pre-money valuation is just only like what it is before that investors' money goes in. They discount any sweat equity, any money that I've had some entrepreneurs put £1 million of their own money into the account, and it's not even taken into consideration. All that matters is the actual state of play right there and then the potential for the future. So no, is basically the answer to that.
Thanks, Paul. Marcus, do you want to unmute yourself and ask your question?
Cool. My question is quickly just on like how to evaluate a blockchain company. So it's like, even like when you're talking about a startup now, like you do like an ICO or you do like an initial token offering, like how would you evaluate that within like getting investments from VCs, and like how to actually evaluate? Because I know it's a new way to actually raise funds as well, which is like a bit of a skeptical one, because it's like it's getting into a regulated market right now. So like they're not really accepting ICOs if they're not regulated properly, or like there's been fraudulent ICOs. But what my question is like, how do you evaluate your company from like before you've got like in industrial investment in an ICO?
Okay, so like with the one you're talking about, is it live at all? Is it pre-revenue? Is it pre-product and everything?
Pre-product, pre-revenue.
Pre-product, pre-revenue. Okay, so a lot of that will be sold on whether it's blockchain or whatever. Obviously, with blockchain's been quite fairly popular for quite a while. But I'll just give the investors' viewpoint on that. Is that they receive like a lot of deals with blockchain in it. and then they find out that literally an entrepreneur's crowbarred blockchain in there to just make it sound cool. So they've just added one strand of what the offering is. It just happened then, and they had to wrap a bit of blockchain around it, and then suddenly it's a blockchain company. So obviously with each kind of sector, some sectors, financial sectors like that, there is a certain amount of risk associated and reward, of course, because if it pays off huge. The multiples on the classic ones, blockchain, fintech, kind of AI, and so on. They are like they have massive multiples. If you look at historically what's happened, then the upside is huge and the downside is huge too, because it could crash and burn so easily. So it's basically heavily discounted when it comes to evaluating the risk on it. But obviously the ultimate is like how you actually take that blockchain, wherever your offering is, and how unique is it in the marketplace, how defendable particularly is it, and what kind of, have you got enough regulation wrapped around it to protect yourself from any kind of wrongdoings or kind of legal kind of snares or anything like that. But the key is, and it's a bit boring really, but is you just really need to get your laser focused on what the big idea is, how big can it be in 5 years time, and then build a really kind of as good as you can get kind of financial model around it. So the financial model should really be able to, like, again, look at the future, but it needs to calculate exactly how much it takes to buy one customer, client, whatever it is. That's usually the missing part with those kind of operations. They just assume that if they got a PR campaign, spend £100,000, they're going to instantly have 1 million clients, customers using it. But you need to just ultimately calculate what it costs to buy one client, customer using whatever you've got. And that's where a lot of the time takes up to justify your valuation. But your valuation is probably going to be quite big, but then the tricky bit is trying to back it up. In the method I've gone through, particularly the poker hand method, you need to prove each of the value points, those cards that you've got.
Yeah, that makes perfect sense actually, because even with like when you said about valuating on like how much each user is going to be, I've kind of thought about that as well, but not in the sense that you've just explained. So it kind of opened up my mind for more opportunities as well.
Yes, yeah, it's well worth thinking about that. That becomes the benchmark. It's like how much it costs to buy a user or customer. What's the average lifetime value of that user or customer? Which obviously builds in an attrition rate. So like, I don't want to get too deep in this, but basically how many people drop off every year. Those are the three things that can really mess you up. Average order size as well, throw in that. And then that's like almost close to 80% of your whole financial model.
Okay. So like,
Great.
sorry, go on. Sorry.
Sorry, Marcus, we just need to move on to the next person. Just want to try and answer as many questions as we can. Is that
Yeah, that's cool.
Paul, after, if that's okay.
Yeah. Cool.
Great, thank you. Yeah. Thanks, Marcus.
Sean, do you want to unmute yourself?
Yes, hi, Paul. Thanks for taking the time out.
You're welcome.
Yeah, I just have a quick question on the valuation method around the IP. I was still a bit confused where it was, you had the idea, which I thought was the patent, and then you have the IP protection. So I thought it was copyright, trademark, patent.
Mm-hmm.
So are they one and two the same, like IP protection and the idea?
Yeah, let me clarify a little bit. So the idea itself is, without stripping aside any IP at all, any kind of protection, how good does the idea really stand up anyway? If you had no IP, could it still win? IP, by IP, I mean, it could be patents, it could be trademarks, could be copyright, but more often than not, it's none of those things. Obviously, if you've got a product or something highly technical, you want a patent, ideally, or a patent pending at least, which doesn't cost a lot of money, or the patent pending bit anyway. And but it doesn't have to be that. So, for example, I had a business once where I would get the supplier that was supplying me goods to sign a contract where they couldn't use anyone else, like myself in my sector, buying stuff from them. I could be the only one, I get a heavy discount for it. So, or it could be geographical. You could create such a barrier that it's actually quite difficult to get in. I had one client, for example, that had a kind of point of sale system, you know, these point of sale, these tills in all the restaurants.
Yeah, EPOS, yeah.
Yeah, EPOS. So he had this back door in there. He had an agreement from two of the main companies to actually have this kind of that basically helped restaurants do sales inside the restaurant. So it wasn't a pickup service; it was a table service. And his dependability, he didn't have any IP around or any kind of patents around it. But I asked him, I said, how long would it take another company to actually get that in, to get what you've done? He said, well, it took us 2 years to get this. And it's very hard. You know, if they're really, really good, maybe 6-9 months. But that's, again, it's just a way of slowing down the competition. I had another company that's called Hirecar, and they had, you know, they basically helped people sell their own or hire their own cars off their driveways if they weren't using it on the weekend. But the barrier to that one was trying to find an insurance company that would back that project. And many people tried, but they managed to get one. And that basically kept the competition away for at least 2 years. So it might be things a little bit beyond that. So as long as you can explain to an investor, you know, it's all good.
Yeah, I think we're getting at it. I think it's something called reach rather than kind of idea, because you know, there's an IP valuation. It's intangible, you know.
Right.
But
yes.
I get what you're saying. Yeah.
Yeah.
I get what you're saying. Yeah, because obviously, you know, someone can steal the idea, but they still have to put in the development.
Exactly. Yeah. Exactly. Yeah. It could be loads of different ways. Maybe you've only got the only expert in the UK. You know, if that you know, they can't. It could be loads of different things. You just have to be more creative with it rather than just patents.
Yeah. Okay. Thank you.
Great, thank you. Just a couple of more questions. We've had so many come in. I don't know if we're going to be able to get them through all of them. But a question from Bill: can we make a valuation based on our marketing assumptions?
Yeah, you can. So like the way that would look, that comes back to the future method again, because that is nearly all future methods. But what you're doing, the key to that one is quite similar to the way I've just explained. But basically, you can make an assumption on marketing predictions, but these marketing assumptions need to be validated at least a little bit. So what that means is you might have done some small trials, tests, where you've worked out that the average cost per click is whatever it is, £5, whatever, that the average cost per then converting that click to a sale is going to end up with an acquisition cost of £10, that the lifetime value is going to be £200 and so on. But obviously it's not an exact science because you haven't been going long enough, but maybe you've done these small trials and tests. Sometimes you can even just spend as little as a couple £100 and get a fairly good indication of on conversions. Sometimes you can find out through competitors or market research or other experts, marketing experts in particular. The key with this one is to be really laser focused, not let's say we're going to go into 12 different channels and hopefully one of them will fly. You just say, we're going to pick these 3 channels and we predict that we're going to, you know, average out between those 3, one will be working probably quite well, one probably will be okay, and one probably will take a bit of time to convert. But on average, we're going to look to get a £10 acquisition cost to buy a customer. But those are the kind of numbers that you need to back up the plan with on marketing. But obviously it can be done. I've done it like many times, where the only thing we've got to go on is pretty much trying to predict the future marketing.
Perfect. Thanks, Paul. Ryan, do you want to quickly unmute yourself?
Hi, Paul. Thanks so much for an insightful presentation. My question, it was in the Q&A box as well. So, but essentially what I was going for is, for a company that is B2B service based, but pre-seed, so hasn't had any, you know, investment yet, the main way of growth has been revenue, right? So one thing that is always discussed is, do you focus on scaling one revenue stream and kind of be narrow in that way, or go multiple? And obviously the challenge with that without investment is you've got finite resources, kind of more more than average. So do you have any thoughts or experiences around that kind of one versus multiple revenue streams?
Yeah, no, that's a really good question. All right, so like on this one, then what you're trying to do is raise money for that single revenue stream and then prove it. But that's not going to be the story going forward into the future. The story is going to be that you might have a different revenue stream or different kind of product or service development. You'd have like a product roadmap basically that you would show investors over the next 5 years, but they're not investing in the whole product roadmap. They're investing in the next product and they want you to validate that bit first. So whatever you're doing right now and it's kind of working partially, but you want to scale it up, you could say, well, we need 250,000 to really, so we can really fly with this. I know the way it works. And if I had 250, I could reach out to 10 clients. I can convert 3 of them. The average order size is going to be X amount. I know this because we've done it before. But we've got a roadmap where we could expand on this service. And here's the 3 ways that service could expand. So the average order size is going to increase. On the lifetime value is also going to increase because now those original clients are going to come back and they're going to reorder something else. I mean, it's absolutely critical for any company that really wants to grow and scale. They can't do it on one product or service. I've seen this so many times. It's crazy that the entrepreneurs are reluctant to, they've got something that works, and then eventually everything has a lifespan, including a product line, and eventually it will just die. One of my clients, for example, he was like 80% of his income was from one crazy product. He was like a kind of like a weird kind of stationary type product. 80% of their income was from that. Now, 5 years later, it only forms 5% of their income. But thankfully, they innovated and they created many, many more different lines. So anyway, does that help?
Yeah, no, it really does. And I think it's one of those points where it's trying to get to enough traction revenue-wise, but to be able to then go to investors with a roadmap that has enough traction behind that sort of one narrow revenue stream to be able to have that sort of use case defined, to be able to go, yeah, this is what we would do with X amount of money. So yeah, no, it really helps. Thanks.
Great. Yeah. So basically, just remember that you're raising money for that product or service, and then you'll almost tell them again, for the next product or service, we need to raise again, but that's fine. So a lot of people are scared of doing that because they think they're going to dilute everyone, which kind of does happen, but essentially what happens is the share price goes up every time unless you do something wrong. Anyway, thanks so much, Ryan. That's a really good question.
Thanks, Ryan. That's really cool. Are you able to take 2 more questions, Paul?
Yeah, I'll take 2 more.
Sure. Tutor Doctor, do you want to quickly unmute yourself?
Sure. Very quick question. First of all, thank you for the presentation. Your own methods were very interesting. I have a running business, so we call it post-sales. It's a franchise business, and I'm looking to sell it after running it for 5 years. My revenue pre-COVID, it harks back to one of the questions you had earlier, was about in the range of 150,000 plus per annum, whereas post-COVID it has come down to sub 100, so 97, 98, that kind of thing. I'm trying to sell the business, and my question to you is, which I had posted in the chat box also, what kind of by the way, my EBITDA percentage is about 30% broadly. I was thinking whether an EBITDA multiple percentage is good for me to look at valuation, and what kind of multiples should I look at for this kind of a business? It's not high tech.
No. Has it got chance to scale, or is it like a standalone cash flow business?
Scale, yes, with more customers, yes, of course. I mean, not that we have reached saturation point from a customer point of view, but definitely revenue can be scaled, but not, as you can understand, the franchise business can't be geographically scaled. It's limited by geography, but yes, revenue-wise, it can be scaled. I think we are on the high end of the profitability because we are quite stringent on operating expenses and all of that, but revenue definitely can be scaled. Okay.
So if it's a franchise business, often they're kind of fairly easy to sell, but difficult to sell for high multiples because obviously you're limited by the license that you've got. So, but ultimately, I'm not like an analyst, and this is like not what I do full time, so I can't just pluck figures out. But I was just as a general idea, I would say that the multiple on that is probably going to be relatively low. As in that it's going to be something like 3 or 4 times maybe profit. So whoever buys it basically they're going to have to wait 3 years or 4 years before they get up on the game. That's obviously that's the way the multiples work. So it won't be on turnover year one. It'll most likely be on the EBITDA, because obviously margins is king, especially with franchise business, and also the predictability. If you can go back a few years and show how predictable the cash flow was coming in, then I would say the standard, I mean, I don't know till you put it out in the market again, but, and there's many companies that do, many sites that you out there that you can just put it on the site and sell them, enterprises like this, like cash flow businesses. And I would say, I would guess at 3 or 4 times multiple. I've had some professional investors go around and literally buy up your type of businesses for as little as 2 to 3 times multiple, but they're looking to get a bargain on it. So they get a bargain on it and they flip it, and pretty much flip it like they would like you would do a house, and then sell it for 3 or 4. So you could get some people really lowballing you on your particular offering, but just a general guideline.
Fantastic. Quick last question. You mentioned some websites where you can go and list this business for sale. If not verbally, can you list? Can you?
Yeah, I don't know any off the top of my head because I don't usually deal with that kind of thing. But literally, it'll be like they're pretty much called like businesses for sale. There's loads of them around. So I couldn't really name one of them. Okay. I would get the one that's been going for at least 10 years. Okay. And then just seeing, you'll probably see deals similar than yourself, and you can probably get a good idea.
Okay, understood. Thank you very much.
Thank you so much. Just one more question, and then we'll wrap up. We've calculated we need 500K for 2 years of runway, and only want to give away 20% equity, which would put our valuation at 2.5 million. And we are pre-revenue, which I feel is very high. Any advice?
So pre-revenue, okay, so I have had deals that would sell for that. So what you need to do though is, like, it depends on the, again, going forward into the future, what does your EBITDA 5-year look like? So ultimately you need to be selling, you want to be looking for a trade sale or some sell event in 5 years or so, where you would sell the company for 25 million. If you work back, that's 10, multiple of 10. But the trick, obviously, if it's selling for company for 25 million, that means that your EBITDA is going to be probably in the region of maybe 3 to 5 million. And so then it work backing from that, then you need to validate how you're going to arrive at that figure over the next 5 years. And it is, I mean, it's not too crazy, to be honest. I've got some that are much bigger than that, but the average I would say is more like a 10 million pound turnover, 2 million pound EBITDA. But let's just say it is 5 million EBITDA in year 5. Maybe it is already, maybe you've already got that on your forecast. But you basically need to go back through, make sure that your financial model can back it up with the same things I've been talking about. Was it cost to buy a customer, average lifetime value, average order size, and so on. And then, but the more you can validate right now, then the easier you're going to find it to sell that. And that means, like, you go to your potential buyers, customers, and you'll get as many as possible to say, I would really love one of those. Get pre-sign up forms, get trials, like even if you haven't got the product yet. You get 3 or 4 companies that would love a trial once you've got the product done. I've had many companies that have, raised significant amounts of money, but what they've done is, without even any product yet, they've gone and scoped out almost like a Frankenstein version of what they've got, taken it to potential clients, say, look, I know this is not pretty, but if you were to have something like this, show them an image on your shelf, what would have to happen for that to be the case? What needs to sell out? Would this sell to your customers? And they get feedback like that. And then sometimes they can refine it, and then to such a degree that, and get them excited, then investors excited in it. So it is totally feasible and I can totally understand not wanting to release more than 20% away. Another way to do it is to break down that amounts. So rather than a 24-month runway, then you're looking for just a 12-month runway. So you might want 250K, it might be more than that, might be 350. You want enough to last you the next 12, 14 months. And then you go and raise again the balance. By that point, you would have validated a lot more, I guess. And then the valuation would be greatly increased. I've had some valuations say, you know, that with clients who started at 650,000 and within like the space of 18 months gone up to 4.2 million. So if you can get traction with just an early bit of money, that might be the way to go on that one.
Great, thanks so much, Paul. Well, thank you so much for your time. I really appreciate it, and I'm sure all our community does as well. If any of your questions weren't answered, please feel free to write them in our Discord community, and we'll get them answered for you, which I put in the chat. I've also shared Paul's details with you, so you can follow him on LinkedIn. You can check out his website. But yeah, thank you so much, Paul. Really appreciate your time, and look forward to seeing you soon.
And thanks so much, Talia, as well, for helping me out here as well, making it so much more smoother.
Thank you so much.
Thanks very much, and thanks everyone for attending. Really grateful for everyone that stayed the distance on this. Hope I haven't ruined your lunch. Anyway, take care.
Bye.
Bye.